On Friday, October 10th, the cryptocurrency market experienced what can only be described as its own version of Black Friday. In just a few hours, more than $19 billion in value was erased. Over 1.6 million traders were liquidated, and the entire chain reaction was sparked by a single social media post. This event marked the largest liquidation in crypto history, leaving investors everywhere asking the same question: is the bull market over? Today, we're cutting through the FUD to unpack exactly what happened. We'll walk you through a minute-by-minute breakdown of the crash, explain why it was so catastrophic, and explore the geopolitical tensions between the US and China that lit the fuse. We'll also dig into the mounting evidence suggesting possible insider trading. Most importantly, we'll discuss what this all means for Bitcoin, altcoins, and your portfolio heading into what promises to be a very uncertain week. Before we dive in, a reminder, I'm not a financial advisor, and nothing here should be taken as financial advice. This is educational content designed to inform you about the recent crypto crash and its potential implications. If that sounds good, hit that like button and let's get into it. To understand the violence of this market collapse, we first need to set the stage. Early last week, the overall mood was euphoric. Bitcoin had just reached new all-time highs above $126,000, and sentiment was extremely bullish. By Friday morning, BTC was still trading comfortably over $122,000. But beneath the surface, geopolitical tensions were building. On Thursday, October 9th, China announced new export restrictions on rare earth minerals, materials critical to products ranging from iPhones to F-35 fighter jets. It was a calculated power move by Beijing, and it didn't go unnoticed. By Friday morning, President Trump fired his opening salvo on Truth Social, threatening a massive increase in tariffs on Chinese goods. That statement alone was enough to rattle markets. Wall Street's fear gauge, the VIX, surged 32%, and Bitcoin began to slip, falling from $122,000 to around $117,000. But that was only the beginning. Later that afternoon came the real blow. In a second post, Trump announced that the US would impose a 100% tariff on all Chinese imports, over and above any tariff that they are currently paying. The moment he hit send, the floor dropped out of the crypto market. Bitcoin instantly fell $3,000, and that was merely the start of an unprecedented liquidation cascade. Within hours, BTC flash crashed to lows near $14,500, even touching $12,000 on some exchanges. In a single day, the world's largest cryptocurrency lost $20,000 in value. Altcoins were annihilated. Ethereum plunged 21%, while major tokens like XRP, Solana, and Dogecoin dropped between 20% and 30%. Others, such as Cardano, Chainlink, and Aave, saw declines of up to 40%. So why was this collapse so extreme? It was the perfect storm: excessive leverage, poor timing, and failing infrastructure. For weeks, leverage had been piling up dangerously. Right before the crash, Bitcoin open interest hit a record $94 billion, like a skyscraper built on shaky foundations. Trump's post was the earthquake that brought it down. Compounding the problem, the announcement came on a Friday afternoon, a time of low liquidity as traditional markets close. That created a domino effect. As prices fell, over-leveraged long positions were automatically liquidated by exchanges. Those forced sell orders drove prices down further, triggering even more liquidations in a vicious feedback loop. In total, $19.1 billion in leveraged positions was wiped out within 24 hours. For perspective, the March 2020 COVID crash resulted in just $1.2 billion of liquidations, and the FTX collapse triggered about $1. This event was nearly 20 times larger than the COVID panic, impacting more than 1.6 million traders. The devastation was worsened by technical failures on major exchanges. Top traders reported that platforms like Binance, Coinbase, and Robinhood suffered order book freezes and disabled stop-loss functions at the worst possible moments. These outages turned what could have been a sharp correction into a full-blown market collapse. While Trump claimed his post came out of the blue, the truth is this trade war had been simmering for months. The underlying dispute centers on U.S. accusations of unfair trade practices and intellectual property theft by China. During his second term, Trump has reignited this conflict with renewed aggression. China's move to restrict rare earth exports was a direct challenge to a key U.S. vulnerability and an attempt to gain leverage before a planned meeting between Trump and President Xi at the APEC summit later this month. Embarrassed after previously declaring the rare earth issue done, Trump retaliated with his signature move: massive, unpredictable tariffs. It's a high-stakes geopolitical showdown, and the crypto market was collateral damage. But the near-perfect timing of the crash has raised suspicions that insider trading might have been involved. On the hyperliquid derivatives exchange, one whale wallet executed a series of impeccably timed trades, earning an estimated $200 million profit. Blockchain data shows the trader, a Bitcoin OG holding coins since 2011, began opening massive short positions on BTC and ETH just days before the crash, and doubled down 30 minutes before Trump's tariff post. Such precision has fueled speculation. Was this a genius macro trader, or did someone get an early tip-off about Trump's plan? Prominent crypto lawyers are already calling for a formal investigation, and frankly, it's hard to blame them. With the market in chaos, the trillion-dollar question is, what happens next? Can Bitcoin and altcoins recover? Here's the good news. Despite the carnage, Bitcoin held the critical $100,000 support zone. After briefly dipping below $12,000, it rebounded quickly and stabilized between $110,000 and $113,000. This suggests the crash was mostly a derivatives-driven leverage flush, not a breakdown of fundamental demand in the spot market. On-chain data even shows that institutions bought the dip. BlackRock's spot ETF reportedly accumulated over 21,000 BTC during the turmoil, while XRP whales added more than 1 billion tokens. In short, smart money still believes the long-term bull run is intact. The fundamentals remain strong, only sentiment and leverage have shifted. The crash may have been brutal, but it reset the market, clearing out excess greed and setting the stage for a healthier recovery. That said, the outlook for altcoins is far murkier. The damage was so deep that many wonder if altcoin season ended before it even began. The altcoin season index has plunged to 55, well below the 75 threshold, signaling a true alt season. Meanwhile, Bitcoin dominance has surged as capital fled to the relative safety of the king. Altcoins can recover, but future rallies will likely be more selective, driven by specific themes such as AI, real-world assets, or potential spot ETF approvals for coins like Solana and XRP. And that brings us to the biggest wildcard for the rest of the year, Donald Trump. The entire recovery now hinges on geopolitical developments. Trump has set a November 1st deadline for the new tariffs, giving a short negotiation window before the October 31st APEC summit. Historically, Trump has used extreme threats as bargaining chips before softening his stance, a pattern traders jokingly call the taco trade Trump always chickens out. He could still walk back the tariffs in exchange for concessions from China. But his 2018 trade war took 18 months to reach a Phase 1 deal, so investors must consider the risk of a prolonged conflict. If tensions persist, the crypto downturn could spread into a broader macro correction. If they ease, we could see a powerful relief rally. At this point, the market is reacting to every tweet, headline, and rumor. To summarize, the October 10th crash was triggered by Trump's 100% tariff threat on China, but it was fueled by unprecedented leverage, creating the largest liquidation event in crypto history, wiping out over $19 billion and affecting 1.6 million traders. Evidence of insider trading is suspicious but unproven. The good news, long-term fundamentals are intact. Institutions bought the dip, and the crash served as a necessary reset for the over-leveraged market. The bad news, recovery depends almost entirely on geopolitics, meaning the road ahead will be volatile, unpredictable, and headline-driven. The bull market isn't over, but the rules have changed. As always, thank you for watching, and I'll see you again soon.